All right, y'all, tons of stuff to get to today on Real Estate Backstage. The big news of the week, of course, is that Compass has reached a deal to acquire Anywhere Real Estate. We also have Zillow that's been hit with a new class action lawsuit. The inflation rate continues to tick upward, but the Fed still moved forward with its first rate cut of 2025. And a federal judge blocked President Trump from firing Lisa Cook. All that and more today on Real Estate Backstage. Now, I do have to give you guys a bit of a warning. I'm recovering from a cold, so I've got a pretty bad sore throat. I may need to stop, drink some tea, or get a cough drop at some point in the middle of this, so just bear with me. Now, before we jump in, if you're watching on YouTube or if you're listening on Apple Podcast or Spotify, make sure to subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes with the links to all the articles that we're going to reference today, you can find that at realestatebackstage.com/episode 40. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield. We are a 4-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. All right, so we're going to start with this news about Compass and Anywhere. This is according to the Wall Street Journal. Quote, real estate brokerage Compass said it has agreed to acquire rival Anywhere Real Estate for $1.6 billion, the clearest sign yet that a long stretch of lackluster home sales is sparking industry consolidation. The all-stock transaction would create a new industry giant with an enterprise value of about $10 billion, including debt, and one of the largest deals ever in the residential brokerage industry. Compass and Anywhere were already the first and second biggest brokerages by volume in 2024, respectively, according to Real Trends. Anywhere, based in Madison, New Jersey, has some of the country's most recognizable real estate brands, including Century 21, Coldwell Banker, Corcoran, and Sotheby's International Realty. New York-based Compass, which has a market value of about $5 billion, is valuing Anywhere shares at $13.01 apiece in the stock swap, about 84% above where Anywhere stock closed on Friday. Compass will assume $2.6 billion worth of Anywhere's debt net of cash. Buying Anywhere gives Compass exposure to international markets and revenue from Anywhere's businesses, including title insurance, escrow, and relocation services. Compass's combination with Anywhere could also help expand its strategy of offering exclusive listings. Compass encourages many home sellers to make their listings available to Compass agents and their clients first, rather than immediately sharing the listing with the broader market. In some markets, the majority of Compass listings start out as exclusive listings, the company has said. Many other brokers encourage sellers to market their home listings broadly from the start to reach more potential buyers, making the Compass strategy controversial in the industry. Compass has sued a multiple listing service in Seattle and listings company Zillow Group over policies that Compass says restrict private listings, unquote. So there are two big hurdles here that Compass is going to have to clear. The first one is regulatory. Federal regulators would have to approve the acquisition. And the second one is from Anywhere's shareholders. Now, the Trump administration has been much more M&A friendly than the Biden administration was. So I think there's a relatively decent chance that we're going to see approval for this from the Trump administration. And Anywhere shareholders, I'm not really sure there. I think the fact that the per share price being offered from Compass is such a significant premium above where it's currently trading, I think there's a pretty good chance that we're going to see approval from Anywhere shareholders for this to go through. Now, they've reached the preliminary deal. They've come to an agreement. It still has to clear those two hurdles. If approved by regulators and shareholders, the actual closing of the transaction would occur, I believe, in the second half of 2026. So we've got, 9 months or so before this is scheduled to actually happen. Now, I've seen a lot of mixed sentiment about this online. I've seen a lot of panic from agents in various Facebook groups saying that this is going to be the worst thing to ever happen to the industry. Consolidation is so terrible. A lot of uncertainty or fear that now Compass is going to have more sway in its battle for these private exclusive listings, which, a lot of people believe would be really bad for the industry to have much less transparency in the marketplace, which I tend to agree with that sentiment. However, I'm also seeing a lot of people excited about this. Surprisingly, a lot of independent brokers like myself are really excited about this. They think that the news of this acquisition is going to create a lot of fear and uncertainty in agents that work for the Anywhere brands like Coldwell Banker, ERA, Better Homes and Gardens, etc. And this could be an opportunity for them to recruit away from those companies. So I don't think this is really going to affect the the day-to-day of the average real estate agent, even if you're at one of these companies that's currently owned by Anywhere, I don't think you're going to see a dramatic change in your business, either positive or negative, as a result of this acquisition. I think the biggest impact of this will be that Compass will have a little bit more sway in the industry when it's trying to push its private listings network, which I am honestly a little bit concerned about. But it's also entirely possible that Compass really doesn't interfere and they just kind of let Anywhere continue to operate and let the franchise brands continue to operate relatively independently. But I'd love to know more about what you guys are thinking, especially if you currently work for one of these brands that's part of the Anywhere family. So drop a comment below or shoot me an email, hello@realestatebackstage.com. I would love to hear what you guys are thinking about this potential upcoming acquisition. All right, in other news, Zillow has been hit with a new class action lawsuit. This is according to Real Estate News. Quote, the law firms that filed one of the original class action lawsuits challenging real estate commissions nationwide have a new target, Zillow. In a draft complaint shared exclusively with Real Estate News, attorneys from Hagens Berman and Cohen Milstein allege the home search giant inflated costs for homebuyers through its Zillow Flex referral program, which charges agents up to 40% for successful transactions. The suit claims Zillow's referrals to agents, which generated more than $2 billion in revenue last year, illegally maintain high and inflexible commissions. We believe Zillow is well aware of the potential for ill-gotten gains in the space and has sought to play fast and loose when real people's basic need for housing is on the table, said Steve Berman, Hagens Berman's founder and managing partner, in a statement. A company with its footprint is not too big to be held accountable, and we intend to support homebuyers who have been harmed. The September 19th complaint filed in the U.S. District Court for the Western District of Washington alleges Zillow is a monopoly in the U.S. market for residential real estate online search services, stating that it claims 66% of the U.S. real estate audience share. Zillow's ability to monetize this dominance is based on deceptive and illegal conduct, the complaint says. When potential buyers are on Zillow's website, Zillow tricks them into signing up with a Zillow agent. If the agent is part of Zillow's Flex program, Zillow gets 40% of the agent's commission, a payment on the back end that is undisclosed to all parties involved, including the buyer and seller, who might want to know that information as they negotiate the sale and close of the listing. The complaint alleges that when buyers press the Contact Agent button on a Zillow listing, they believe they are contacting the listing agent, not a Zillow-affiliated buyer's agent. If buyers were directed to sellers' agents, they would be better positioned to negotiate a lower purchase price because the seller would not have to pay commissions to the seller's agent and the buyer's agent, the complaint says. The program incentivizes Zillow Flex agents to prioritize receiving his or her full commission at all costs, the complaint alleges, because those agents are netting a lower commission after paying referral fees. This complaint fundamentally misrepresents how Zillow operates and the values we've delivered to buyers, sellers, and real estate professionals for nearly 2 decades, a Zillow spokesperson said in a statement to Real Estate News. Contrary to its claims, we stand by our long-held belief that buyers and sellers deserve to have the choice to work with an agent who is committed to their best interests and only represents them. We will vigorously defend ourselves against these claims. The suit seeks class action status on behalf of all U.S. buyers who bought a home listed on Zillow in the last 4 years using an agent they were referred to through Zillow, unquote. So this is definitely an interesting lawsuit, and I agree that most consumers are probably unaware of the fact that when they click that button on websites like Zillow and Realtor.com, that they're not necessarily getting their inquiries sent directly to the listing agent, but rather those sites are selling that lead. Now, of course, if they read the fine print, they would understand that. But I think most consumers don't really stop to think, how does this company make money? How does Zillow afford all of the money it spends to build and maintain the website? Consumers don't think like that. They see a button that says Contact Agent, they assume it's going to the listing agent. I do agree with the basic premise that buyers are better served to have their own agent who is not the listing agent. I think 99% of the time that makes the most sense for a buyer to have someone in their corner representing their best interests. And also, a lot of the listing agents are not necessarily responsive. I think if the inquiries do go directly to the listing agent, a lot of times, unfortunately, that listing agent is just not even going to take the time to respond to the lead. It sounds crazy, but it happens. Someone who is actually spending good money for that lead is much more likely to be proactive and responsive. I think especially companies like Realtor.com, where they don't do exclusivity, where the lead is being sold to real estate agents, there's definitely an incentive to be quick and respond to the customer and provide value because you're competing for that business. So there's definitely different incentive structures there. You compare that to Homes.com, which is owned by the CoStar Group, for example. Their big platform, their big selling point to real estate agents is the whole your listing, your lead model, where if a consumer goes on Homes.com, they see a property they like, they click the button, that inquiry is given directly to the listing agent at no cost. And Homes.com makes their money by selling advertisements, promoting real estate agents where they can promote themselves and their listings to gain more visibility on the website. So it's definitely a different business model. But in general, I think consumers really don't understand how these things work. Now, just because a consumer doesn't understand how it works, it doesn't mean that Zillow is doing anything wrong or illegal. It is a free country, last time I checked, and Zillow has every right to operate its website the way it sees fit and to sell or distribute leads the way it sees fit, as long as it is complying with the law. So I'm not really sure that there's a leg to stand on here, that Zillow somehow harmed consumers. I really think maybe they've harmed real estate agents by asking for such a high referral fee. I'm sure a lot of you would probably agree with me on that. But it'll be interesting to see how this actually plays out. If it gets to court, I'm not sure if they're going to settle. But personally, just selfishly from the sidelines, I would love to see this go to court so I could see the arguments made on both sides and see how it all shakes out. All right, in other news, we have inflation continuing to tick up. This is according to RIS Media. Quote, the Consumer Price Index, CPI, an inflation gauge overseen by the U.S. Bureau of Labor Statistics, was up 0.4% in August after rising 0.2% in July. This brings annual inflation in the CPI's all items index up to 2.9% before seasonal adjustment, compared to 2.7% in July. This means that annual inflation is currently continuing to inch up further away from the Fed's goal of 2%. The index for shelter costs rose by 0.4% and was the largest contributor to the increase in the all items index. Excluding the food index, which rose 0.5%, and the energy index, which rose 0.7%, the all items index posted a 3.1% annual increase. I believe there's actually a typo in the article that should say the core index, not the all items index. Realtor.com senior economist Jay Krimmel projected that higher food and energy costs could be the result of tariffs. Other tariff-sensitive goods, such as cars, new and used, and home furnishings also reported price increases per the CPI, unquote. So the Fed's target for inflation is 2%. We've been stuck close to this, 2.5% to 3% band for quite a while now. The last several months, we've seen the CPI moving in the wrong direction. However, despite that, the Fed still moved forward with cutting rates at their most recent meeting. And that's because they're really starting to prioritize the labor market over the inflation data. Really what it comes down to is at this particular moment, the Fed is viewing the risks from the labor market as more significant than the risks from inflation. This is according to Housing Wire. Quote, the Federal Reserve lowered its benchmark interest rate by 25 basis points on Wednesday, setting the target range to 4% to 4.25%. The first cut since December 2024 marks a new phase in the central bank's effort to balance maximum employment and stable prices. So that is the dual mandate that the Fed has. They are supposed to maintain price stability and employment stability, full employment and price stability. And those things are at odds with each other. So the tools that the Fed uses to fight inflation tend to have negative implications on the labor market and the rest of the economy more broadly. Economists say it could usher in an easing cycle with direct implications for housing. Recent indicators suggest that growth of economic activity moderated in the first half of the year. Job gains have slowed and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated, the Federal Open Market Committee said in a statement. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about economic outlook remains elevated. The committee is attentive to the risks of both sides of its dual mandate and judges the downside risks to employment have risen. The move brings benchmark rates back to the levels last seen in November of 2022, when the range stood at 3.75 to 4%. Fed officials have acknowledged that inflation remains above the 2% annualized target, but they pointed to softening labor market data in the decision to lower rates, suggesting their stance may have become overly restrictive. Inflation accelerated in August, rising 2.9% year over year compared to 2.7% in July, according to the BLS. On a monthly basis, inflation increased 0.4%, double July's 0.2 figure. Meanwhile, non-farm payroll employment rose by only 22,000 jobs, and the unemployment rate held firm at 4.3%. Fed Chair Jerome Powell told journalists on Wednesday that while the unemployment rate remains low and has edged up, job gains have slowed and downside risks to employment have increased. Inflation has risen recently and remains somewhat elevated, while changes to government policies, including higher tariffs, continue to evolve, leaving their effects on the economy uncertain. Powell said a reasonable base case scenario is that these effects will be relatively short-lived, but they could also prove more persistent, a risk that needs to be managed. Based on this assessment, the Fed shifted monetary policy from restrictive to more neutral territory. Wednesday's Fed decision comes after sustained pressure from the Trump administration, which has pushed for faster monetary easing, unquote. So I think if it weren't for the tariffs, if it weren't for the couple of really bad jobs reports that we've received recently, the Fed would have cut earlier in the year or maybe cut more. This uncertainty over the Trump tariff regime is really causing a lot of hesitation among the Fed governors. And it's entirely possible that a lot of the low jobs numbers that we're starting to see are a result of the tariffs. So what's really interesting from the meeting is if you look at the dot plot, if you read the actual statement, a lot of I think about half of the Fed governors, the members of the FOMC, are anticipating 2 more quarter-point cuts before the end of the year and at least 1 cut in 2026. All right, shifting gears, homeowners have rushed to refinance as mortgage rates hit a 2025 low. This according to Inman. Quote, homeowners rushed to refinance last week and mortgage applications from homebuyers hit their second highest level of the year as mortgage rates descended to new 2025 lows in anticipation of several Federal Reserve rate cuts in the months ahead. The Mortgage Bankers Association's weekly application survey showed requests to refinance jumped 58% last week compared to the week before and 70% from a year ago. Indicative of the weakening job market and in anticipation of a rate cut from the Federal Reserve, mortgage rates last week dropped to their lowest level since last October, with a 30-year fixed rate declining to 6.39%. NBA chief economist Mike Frantantoni said in a statement. Almost 60% of applications were for refis, but there were also a pickup in purchase applications. Rates on 30-year fixed-rate mortgages tracked by Optimal Blue fell to a new low of 6.17% on Tuesday as investors in mortgage-backed securities that fund most home loans price in expectations for several Federal Reserve rate cuts this year. With the expectations for Fed rate cuts now priced into mortgage rates, further reductions will depend on whether central bank policymakers continue to view deterioration in the job market as a greater threat to the economy than inflation, unquote. So the last time I checked, 30-year rates were about 6.2%, lowest they've been this year. We're certainly encouraged by that. I think if you look at the primary factor driving the reduction in mortgage rates, it's been the shrinking of the spreads. Mortgage spreads right now, which is the difference between the yield on 10-year treasuries and the average 30-year fixed-rate mortgage, those spreads have compressed. They're certainly much better than they were last year and the year before. If we were operating right now with the same spreads that we were seeing in 2023, mortgage rates would be above 7% right now. I think they'd be closer to 7.5%. So definitely happy to see mortgage spreads compress. All right, in other news, a federal judge has blocked President Donald Trump's attempt to immediately remove Lisa Cook from the Fed. This is according to the Wall Street Journal. Quote, a federal judge late on Tuesday blocked President Trump from removing Lisa Cook from the Federal Reserve Board of Governors while a lawsuit challenging her firing proceeds. Judge Giacob in Washington, D.C. granted Cook's request for a temporary court order to keep her seat on the central bank's 7-member board for now. Cobb said Cook is substantially likely to succeed on her claim that Trump violated the Federal Reserve Act because her purported termination didn't comply with the statute's requirements that officials can only be removed for cause. Removal was not meant to be based on the president's assumptions about the officials' future performance as extrapolated from unproven conduct dating from before they assumed office, Cobb wrote. The administration said in court filing Wednesday that it was appealing the decision. This ruling will not be the last say on the matter, and the Trump administration will continue to work to restore accountability and confidence in the Fed, a White House spokesman said. Cook's attorney, Abby Lowell, said the decision recognizes and reaffirms the importance of safeguarding the independence of the Federal Reserve from illegal political interference. Cook's lawsuit has set off an unprecedented legal battle, testing the president's power over the central bank, which is likely to quickly reach the Supreme Court. Job protection at independent federal agencies has been weakened by recent Supreme Court rulings and has never been tested in the context of the Fed. However, the Supreme Court suggested earlier this year that Fed employees have more protections than those at other agencies, unquote. All right, so this court order does not say that Trump can't fire Lisa Cook. It just says that she is able to remain in her job until the lawsuit is able to be fully litigated. And I do think the Supreme Court is going to take this up rather quickly. They're going to want to put this issue to bed rather than having it linger out there. All right, I found this article from Inman interesting. It's titled, "Does this new housing data foreshadow a recession?" Again, this is according to Inman. Quote, "In the latest sign that the U.S. economy and its cold real estate market continue to slog through uncertainty, new home starts slid 8.5% in August, according to new data released on Wednesday by the U.S. Census Bureau. The number of new permits fell 3.6% from July to August and 11.5% compared to a year ago. The dip brought the number of new single-family home permits to its lowest level since March of 2023. Economists pointed to a glut of unsold new homes, uncertainty created by the Trump administration's tariff policies, and general malaise in the U.S. economy. All things considered, this month's new construction data points to a market that is still under strain," said Hannah Jones, senior economic research analyst at Realtor.com. August release shows that builders are pulling back on future projects, even as they push to complete existing ones. Supply will likely tighten further down the road unless demand conditions improve and permit activity stabilizes. New permits are considered the most forward-looking metric in the data released by the Census Bureau. New permits have fallen in 9 out of the past 12 months. New home completions jumped 8.4% from July to August. That figure was also down 8.4% from a year earlier. Economists said that the slowdown was consistent with overall builder sentiment, which has been negative for the past 17 months straight. Single-family construction is trending lower as builders work to balance elevated inventories with softer demand, pressured by affordability challenges and improved resale supply, said Odita Kushi, deputy chief economist at First American. Meanwhile, single-family permits continue to signal pressure on building activity. The new report is the latest sign that the new construction market is flashing warning signs for the broader economy and a possible continued ice-cold real estate market. Lisa Sturdivant, the chief economist at Bright MLS, noted in a statement that residential building activity can be a recession warning sign. A pullback in residential building activity has historically preceded an economic recession, Sturdivant said. When home building slows, it has a ripple effect across the economy. Declining new construction also reflects less consumer demand and indicates that overall consumer spending could be waning, unquote. So we've definitely started to see a decline in the number of residential construction workers in that particular segment of the labor market. Whenever we see that's a really good leading indicator. The reduction in jobs in residential construction workers, that usually precedes a recession by 6 to 18 months. I'll put a chart up on the screen for those of you watching on YouTube, but if you look at the long-term trend line for that data point, I think we've got maybe 40 years of data on that. You'll see that it is a pretty good leading indicator. Whenever we see a peak and then a downward trend in the number of people working as residential construction workers, there tends to be a recession shortly afterward. The question is, have we peaked? Are we starting that downward decline? Or is this just a little blip before we go back up? I think if we can get some more economic certainty, if we can get lower interest rates, then we might see a reversal of that trend. All right, so you may remember that CoStar filed a lawsuit against Zillow over copyright infringement, claiming that it had thousands of images on its website that were copied from CoStar. A lot of them even still had the CoStar watermark on the images. Well, Zillow has started taking those down. This is according to Inman. Quote, "Just over a month ago, CoStar sued Zillow over what it described as systematic copyright infringement. The portal giant has begun taking down the images at the center of the litigation from its websites. Zillow began taking down the images this week and is in the process of notifying partners," a company spokesperson confirmed to Inman. The spokesperson added that the move is a routine procedure during copyright litigation. The suit began in late July when CoStar accused Zillow of systematic infringement of CoStar's copyrighted photographs. According to CoStar's complaint, Zillow was displaying nearly 46,000 CoStar copyrighted images on Zillow rentals. Many of the images, CoStar also claimed, still have the CoStar watermark and were displayed more than 250,000 times on Zillow sites, as well as on sites run by Redfin and Realtor.com, which have listing agreements with Zillow. CoStar CEO Annie Florence said in a statement at the time the suit was filed that Zillow's theft of tens of thousands of CoStar Group's copyrighted photographs is nothing short of outrageous. In the copyright lawsuit, Zillow has yet to file an official response to CoStar's complaint. The company has until the end of this month to do so, unquote. Meanwhile, Opendoor is planning to expand nationally after a recent run in the stock market and a shakeup in the C-suite. It's according to Real Estate News. Quote, "Opendoor has revealed that it will be expanding its offerings across the continental United States in the coming weeks, according to a new SEC filing. The PropTech SEC filing. The PropTech company, which has recently witnessed a flood of interest from retail investors and welcomed a new CEO, appears poised to capitalize on this momentum to bolster its growth and service footprint. The short 8-K filed on September 16th offers few details, but indicates that the company will soon expand its service area to the entire continental United States. These services include the iBuyer's direct cash offer to homeowners, its Cash Plus buy before you sell product, and its partner agent program, Key Agent. In May, NASDAQ warned Opendoor that it could face delisting if its stock price didn't rebound. But the iBuyer was back in compliance by late July, following a sudden and unexpected price surge. The meme stock effect, largely thanks to EMJ Capital founder Eric Jackson's vocal enthusiasm for the company, helped push the iBuyer stock price over $10 by mid-September. Opendoor shares have risen 765% over the past 6 months. Opendoor noted its expansion plans just days after experiencing a notable leadership shakeup. During the iBuyer's July and early August stock price rally, Jackson called for change, and by August 15th, Carrie Wheeler had announced she was stepping down immediately from the CEO role. Less than 1 month later, Opendoor on September 10th named former Shopify COO Kaz Najeetan its new CEO and announced the return of co-founders Keith Rabois and Eric Wu, both of whom have rejoined Opendoor's board of directors. Rabois suggested during a September 12th interview with CNBC that big layoffs could be ahead for Opendoor staff. There's 1,400 employees at Opendoor. I don't know what most of them do, he said. We don't need more than 200 of them. However, Rabois did not specify when cuts would be made or if they would occur at all. I haven't yet dug into the financials, he explained. I won't opine about the future, financial future, etc. I know the strategy. I have a high-level view of the strategy of things that can be improved, but there's no way you need 1,400 employees, unquote. All right, in other news, Ethan Glass has joined Compass as the chief legal officer. This is according to RS Media. Quote, Ethan Glass, a prominent antitrust attorney at the Department of Justice for nearly a decade, who later in private practice represented the National Association of Realtors in its defense against DOJ scrutiny and private antitrust lawsuits, has been hired by Compass as its chief legal officer, the firm announced on Tuesday. With decades of experience in antitrust litigation, Glass previously led teams at the DOJ that investigated and sued multiple listing services for alleged anti-competitive conduct, according to the release. In private practice, he represented NAR in its defense against Michael Ketchmark and team during 2023's landmark Burnett vs. NAR and others commission lawsuit. Glass most recently served as head of the global antitrust and competition practice at Cooley LLP, one of the leading technology law firms in the country. According to Compass, his appointment reinforces the firm's commitment to protecting seller choice, challenging coercive industry practices, and empowering agents to market their clients' homes without restrictions from MLSs and third-party platforms like Zillow. At Compass, we firmly believe agents should not be fined by MLSs or banned by Zillow for marketing listings off their platforms, and that no agent should be told by an MLS or Zillow how they must work with their clients, said Compass founder and CEO Robert Refkin. Bringing Ethan Glass on board as our chief legal officer reflects our unwavering commitment to seller choice and challenging these restrictive practices that limit when, where, and how homeowners can market their homes, unquote. All right, I want to wrap things up with this article from RS Media about VA loan reform. Quote, after serving our country, veterans shouldn't face unnecessary barriers when trying to buy a home. Yet that's exactly what happened under an outdated Department of Veteran Affairs rule that barred veterans from paying their real estate agents, making them the only homebuyers in America prohibited from directly compensating professional representation. Now Congress has delivered a solution. The VA Home Loan Reform Act, which is H.R. 1815, has been signed into law by President Trump after passing Congress unanimously, correcting a fundamental unfairness that has disadvantaged veterans in one of life's most important financial decisions. The VA Home Loan Guarantee Program is one of the nation's most successful homeownership tools, enabling veterans to purchase homes with no down payment. But there was a catch. VA policy barred veterans from paying their real estate representation. That meant if the sellers didn't cover the homebuyer's agent fee, a scenario that's become increasingly common in today's market, veterans found themselves caught in an impossible situation. Use their hard-earned VA loan benefits and risk being outcompeted, or abandon the benefit altogether, unquote. So the National Association of Realtors had actually advocated and convinced the VA to temporarily suspend this policy last year after the Sitzer Burnett case was settled and after the new NAR rules went into effect last August. NAR successfully lobbied and got the VA to temporarily suspend the rule, which prohibited veteran borrowers from paying the real estate agent directly. However, this law now makes that change permanent. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with links to all the articles we referenced at realestatebackstage.com/episode 40. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.